Learning Objective 4 deals with foreign currency exchange rates. Specifically, if you have a sale in a foreign country that's denominated in a foreign currency, then the value of that sale is going to need to be translated into US dollars. And as the exchange rate changes, then the value of that sale is also going to change accordingly. So companies do conduct business in foreign countries using foreign currencies, and they keep their records in the local currency, and these need to be translated. So exchange rates between the United States and other countries do change, and as the US dollar gets stronger or weaker, then the relative value of these sales will go up or go down. So if the US dollar becomes stronger, then the value of foreign sales is lower. And if the US dollar becomes weaker, then the value of foreign sales is going to become higher. And let's look at it. In here you can see some examples. If the US strengthens between the date of the sale and the collection of the receivable, then the company suffers a loss. And that would be a situation because you had expected the value of the sale to be a certain amount of money in dollars, but because you had collected them in euros instead, it was denominated in euros, and you collected them in euros, then the actual amount of money that you received went down. And in the other direction, if your company buys goods denominated in a foreign currency, then the amount that you need to pay may fluctuate based on fluctuations in that currency, and that may cause a foreign currency transaction gain or loss. If you borrow money denominated in a foreign currency, then the amount of money you pay back is going to depend on the value of that currency. So if that currency becomes more expensive, then you have to pay back more. If that currency becomes less expensive, then you can pay back less. Now, there are also laws that say that when you have cash in foreign subsidiaries, you can earn profit on your activities pretty much tax-free. But when you bring the cash back to the United States, or you send it back to the United States, then it becomes taxable. And the value of those transactions will also change with the values of those foreign currencies. When you have a transaction, these are realized losses. However, the situation which isn't really described here is if you have a subsidiary in a foreign country, that whole subsidiary's financial statements are going to be denominated in their local currency. So for example, let's say you have a subsidiary in France and its balance sheet is denominated in euros. If the value of euro goes down, then the entire value of the subsidiary is going to drop along with it because it's in euros. So if the euro is worth less, then the whole subsidiary becomes worth less, and that creates a loss. It could work in the other direction. Let's say the value of the euro goes up, then the whole value of the subsidiary is going to float up with the value of the euro, and therefore you're going to have a gain. These gains are considered to be unrealized gains, and they go to other comprehensive income. They do not go to income. Now, what also can happen is companies could hedge these risks, in which case the gains and losses would be reduced. So by introducing hedging transactions, the companies can hedge the risk of a foreign currency gain or loss, and thereby reduce that gain or loss so that it'll have a minimal impact on the income statement.